What's up, guys? Jonathan Beasley back again, and today we're talking about how to bulletproof your real estate strategies for the remainder of 2022 and into 2023. And it's super important because the Fed is doing crazy stuff with interest rates, so we're going to talk about it today. Whether you're a buyer, a normal, like a civilian buyer, is that the right word? Civilian? It's not like investors are in the military, D-Mac. Maybe the layman. Whether you're a layperson buyer, just doing the buy-sell thing for yourself and your family, or you're an investor, this video will certainly benefit you because I'm going to tell you exactly how to look at the market and where your mindset and your strategy needs to be. So let's get into it. It starts now. So crazy interest rate hikes are happening. The Fed is telling us explicitly that they're going to continue to happen. So let's talk about how we got here. What got us here? So over the past 24 months or so, I would say what's happened has been largely unprecedented. We've never seen anything like what's happened. We've had very low cost of money. So entry point into investing has been super easy. Even for home buyers, it's been really easy. The dollar has gone really far because you could borrow for like 3.5%. At stretches rates, the prime was at 0%, which is like unheard of here. We've seen massive amounts of government infusion of capital in the form of printing money. As a matter of fact, almost 50% more dollars have been printed over the past 24 months than in the past 24 years. Dylan, that's as long as you've been alive, bro. So what this has done is cause assets to hyper appreciate. You've basically been able to close your eyes, throw a dart, and still hit the dartboard, especially in real estate. And to be perfectly honest, it's made a lot of investors and even layperson buyers look a lot smarter and better than they might actually have been. You could really buy anything over the past 2 to 3 years and it was gonna be worth more as long as you didn't way overpay. It's gonna be worth a lot more in a fairly short period of time, relatively speaking to historical trends. So you could sell it and make your return, or if you'd bought reasonably right, you could get a loan on it. It was most likely going to cash flow well. Now what we've seen is the government and the Fed are stepping in and making some changes, and they're indicating that these changes are here to stay and even get worse, so to speak, for a period of time. They're essentially trying to address a number of self-inflicted problems, in my opinion. We won't get into that now, but not the least of which is a labor problem. There has been and continues to be a shortage of labor. As of today, there are 11.5 million job openings in the market, and they need to be filled because it's causing a significant economic impact. So costs of wages are skyrocketing, people aren't coming to work, things aren't getting done as quickly as they normally would, and we feel this specifically in the real estate industry. Like my team does a lot of new construction, and the average build time is still almost double currently what it was pre-pandemic, and this is almost exclusively due to shortage of labor and shortage of materials. So you couple all that with the fact that the stock market hit all-time highs this summer, and Bitcoin and various cryptos have been skyrocketing all year, and of course real estate's been appreciating at like 10 to 15, 20, in some markets like 50% a clip for several years straight. So what is the Fed doing to counteract the situation, and how do we need to respond? Because that's what this is about. They are rapidly increasing rates. Over the past 90 days, we've seen the rates almost double in some sectors, which is like significant. If you're an owner-occupant buyer, a lay person, a civilian, if you were getting rates maybe around 3% like 3 months ago, 3 to 3.5%. Now we're looking, our last clients this past week locked in at like 5.5%. So that's a significant increase. As an investor, we were getting money, 4.5 to 5% earlier this year. I just locked in a 3-unit refinance at like 7.65%. So these sudden increases are massive and they really impact your numbers. And that's why it's so important that you put the right plan in place when you're looking at your next deal. So what can you do? Well, the first thing you need to do is fatten your pro forma. So what does that really mean? Any property that you're buying, that we're buying right now, we're making sure that the walk-in margins are actually greater than we've been underwriting previously, which means we have to look at more deals and we have to turn more deals away. We got to get a little more scrupulous with the deals that we're actually taking on and purchasing. So over the past 24 months, we personally, my team, we've been looking at skinnier margin deals, 10 to 12% returns on average, not factoring in leverage. So like just strictly cash on cash return. And we've been happy with it because we've known that there's been a massive tailwind behind us. The market, the greater economic market, has been pushing values ahead. So we could be happy with 10% returns. Now we're looking for deals on paper that need to generate more like 14 to 16% returns. And the purpose of this extra padding in our pro forma is going to allow for any type of pricing adjustment or pullback from the markets especially as the cost of money is getting more expensive. So remember, the cost of a mortgage right now is anywhere 30 to 40% higher than it was just 3 months ago. And so the buyer buying your next flip property, or you as a purchaser looking to purchase a home right now, you're gonna be paying a lot more, even though the list price isn't necessarily going up. So you have to be really sort of underwriting cautiously with your numbers. The second thing that we're doing, also sort of akin to number one, is ensuring that our analysis is bulletproof when we're looking at comparables, and this goes for both investors as well as civilians. You need to make sure that whomever's running your comps is doing it in terms of cluster comps instead of just sort of cherry picking the peak comparable sales, because the market for such a long time was appreciating so rapidly that everyone just got accustomed to using the top of market comps. Now there are nuances to all of this, and if a property is in peak condition, well, you know, if you've renovated it, if it really is at the top of market, then you do adjust in accordance with the top of market comps. But gone are the days of just assuming that your regular resale or your sort of, you know, rental grade finished property is going to be the new record sales price for the area. Those days are gone, and we're starting to see those prices pull back at the top just a little bit, so be aware of that. The third thing that we're doing, especially when we're looking at our BRRRR style properties, which is a lot of what we do, is we're packing the pro forma with higher rates, and we're sort of building in an increased rate 6 to 12 months out from now, because that's when we'll be refining. So when you're buying a BRRRR property, you buy it, renovate it, you rent, refinance, and then repeat. It takes time in a market, especially when the Fed is saying they're going to be increasing interest rates. It takes time to get that renovation done. So you have some risk exposure as an investor doing the BRRRR strategy in this market, because increased interest rates are just moving against you. So you want to mitigate the risk by factoring for this down the line. So for example, if I'm looking at a property right now and I want to do a BRRRR on it where I have to renovate it for say the next 90 days, my current rate would probably be, you know, 6.75, 7%. But when I go to do my refinance in 3, 4, 5, 6 months, the rate might actually be like 7.5, 8%. So you need to make sure, we need to make sure as smart investors that we're accounting for this increase down the line and making sure that the deal doesn't work just with today's interest rates, but it actually works with future interest rates as well. You want to do this also because the bottom line is the Fed is not lying. They've already followed through with the rate increases that they've talked about, and they've told us they're probably going to do 2 to 3 more in the remainder of this year and into 2023. So if your deals only make sense to buy on the now rate, you'll definitely want to revisit that strategy. Now, that sounds like a lot of doom and gloom and a lot of fear talking. I actually don't want to present a message of fear, just of caution, and there is a difference, because here's the reality. On the bright side, real estate is extremely forgiving, and if you plan to hold properties for a few years, you are going to win over time. It's a matter of fact. It's just the way it is. People will always need a place to live. And as a matter of fact, an investor friend of mine kind of blew my brain recently, and he basically said, Jonathan, I could sum up successful wealth building through real estate to this one thing. And so my eyes got big and I got kind of pumped, because who doesn't like a good life hack for doing massive amounts of big stuff in one simple principle rule? So I got fired up. Normally I don't buy into hacks, because the idea of like doing huge stuff but making it sound easy is like bad news. But this one was interesting because he actually followed through with it. And here's the key. He nailed it. The key is this: don't ever stop buying cash flowing real estate. That's it. If you simply figure out how to buy cash flowing assets using good debt, and you repeat this process over and over and you never stop, you will build massive wealth, the likes of which your grandchildren and great grandchildren will feel. So that's it. Start buying cash flowing assets and don't ever stop. So what do you guys think about this market? Is it driving you crazy? I gotta be honest, I am sort of fighting a little bit of fear because it's stressing me out. It's making it a little more difficult to operate as a real estate investor, but I won't be deterred, because I'm gonna stick to the lesson that my friend told me. Just not gonna stop buying cash flowing assets. It's funny, I told Rachel this morning, it's like the Fed seems surprised that printing trillions of dollars in new money and giving it away would cause people to spend it. It's like, oh, what? You didn't know this would happen? But it's all good, no politics here. If you guys like this video, please smash the like button and give me a subscribe. I'm always here to help and to quite simply share with you guys my own personal wealth building journey via real estate. Ooh, by the way, I think I got flip number 5 under contract in our flip series of Flippin' 10 during a recession, and this one is a waterfront duplex in Hatteras Island, North Carolina. So I'm pretty pumped to share that with you guys. But until next time, I'm Jonathan Beasley signing off. Like and subscribe, comment below. Talk to you soon.